In this video, guys, let's explore why your stop might not have been filled. Stay tuned. Hey traders, warm welcome to you. All right, so why might your stop not have been filled? Sometimes as a newer trader, you go, hey, I have a stop in, why have I not been filled? Or why have I been filled at an absolutely awful price? So maybe this short video, I can highlight why that might happen and give you some ideas onto maybe improving your stop loss positioning and to understand how to use stop losses a little bit more effectively and where the limitations are. Okay, so you might put it, you know what a stop loss is, I'm pretty sure you know what stop loss is. You just imagine a long, you go long and you say, right, I want to come out at a certain price. So maybe you go long at, imagine you go long here at $50, for example, and let's say you have a stop here at $49, right? For whatever reason, you're like, okay, I think we're gonna go to $55, but if we go down to $49, I wanna close the trade. Fine, could be any instrument, Forex, commodities, indices, spread bet, CFD, you name it. You guys know what stop is. Okay, so sometimes, or should I say, the majority of the time, you're gonna get stopped out, market's gonna go up, comes back, trade's not valid, doesn't work out, bang, take the loss, move on to the next trade. You get filled at around 49. Sometimes you get a little bit of slippage, but it's normally around that. If you're in a decent thick market and you're not trading massive amount of size compared to the market, you're gonna get filled at 49, right? But sometimes your stop doesn't get filled, or sometimes, very rarely, you kind of get this massive slippage and you think, well, what's going on? Why am I not getting filled? Why is it not executing as I expected? Okay, so a couple of things here. One is there's a difference between a stop market order and a stop limit order. And one reason your stop might not have been filled is that you have said most, I'd say 95 or 99% of stops are defaulting to a market order. They basically say, if the price gets to $49, sell at market. And you're gonna get filled at 49, or maybe you're gonna get 48.95 or something like that. You're gonna get filled pretty close, right? And depending on how quick the market is, depending on how much the slippage, you'll get to that in a moment. If you have a stop limit order, as the price goes through 49, if you're saying, hey, I want that to be triggered and put in a limit sell order at 49, if current price is trading at 48.70 or 48.95, 48.99 even, you're not going to be filled. And so you'd be sitting there with a sell order that actually means that you're not filled and the price is going lower, and it's not filled because it's not a market order. It's run through the price. By the time that price has been triggered and sent to your broker and come back and put the order through, it's not at the right price, you're not going to get filled. Now that's rare, and you have to, most of the time, you have to actually actively go and choose to trade that way. If you're trading CFD and spread bet, not unusual to have those there. But if you're trading directly on the exchange, or using one of the institutional grade brokers who trade directly on this exchange, New York Stock Exchange, one of the futures exchanges, etc., then you can program to have a stop limit order in, and that might be why you've not been filled. Worth checking out if you think, why has this stop not been filled? Okay, so let's talk about slippage now. So slippage, this is basically when you say, hey, I got a sell stop at 49 and I got filled at 48.70, or I got filled at 48.90. That is slippage. And slippage is basically because the price has moved, and by the time the price has triggered your stop, and by the time it's come back to the market, that price has changed. And so you guess most people kind of accept that. Sometimes you get a little bit, but what happens when you get massive slippage? You're like, what happened? Why did it not get filled? And I think the first challenge we have to understand as newer traders is when we have a fast, immediate news-based market. So if the price has been chugging on at 50, it's gone up to say 51, you've got to stop there at 49. If price has just gone through the floor, some sort of news has come out, people have hit those bids, and you don't get filled at 59, all of a sudden you're filled at 48, you're going, what? Why have I got $1 worth of slippage? That's ridiculous. That's because the market has moved so fast, so quick, there aren't any bids there. So you can imagine prices going, I'm going to kind of generalize this and summarize it a bit more. You've got these levels in between, for on the order book, 50, and then you'll have kind of 1 cent increments, probably depending on what you're trading. If someone takes out all that order book, let's say news comes and you've got a massive amount of people just hitting those bids, wanting to get out because it's bad news, companies going bankrupt or something stupid like that, they're going to sell at 50, 49, for all those price levels. By the time it trades at 49 and sends the signal out to your broker, it's going to be run straight through, because that might be one order that just takes 49, 48.95, 48.90, 48. It might take all of that, and by the time it comes back, your broker goes, oh, it's hit 49. The computer goes, send that sell order in. Full sell order goes in. You're in a massive group of other sell orders that are coming from all over the world. The price may well be at 48 by that time, so you're getting massive slippage. It's unusual, but on some times you will get this, and obviously there's circuit breakers in place to prevent this happening with stocks and stuff. However, you're then in a situation where price is halted, and then what do? You can only then resume trade when trade is resumed, and then you might get slippage. So this might result in this, but this is really the gap scenario. So the gap scenario is when it doesn't really affect Forex traders except over the weekend, and the thicker the instrument, the less likely to be a big gap. But generally speaking, a gap is defined as a time period when you cannot trade. So the close of the stock exchange, that's done, right? The stock exchange is closed. Yes, there are after-market hours and pre-market stuff, but even after then, imagine it's closed, you can't do any more trade, bang. There's nothing, no dealing to be done. 2 o'clock in the morning, US time, you can't trade Apple. And so you then have to wait for the open to be able to trade Apple. Now, if something happens in that stock overnight and you're long, some freak news comes out and says, I don't know, Apple iPhone sales are down to 2 phones a day or something ridiculous. I think that would be pretty bad for Apple. That type of thing, you will then be long. You might have a stop again, you might be long at $50. This wouldn't be Apple, but $50, you're gonna stop at 49. If it opens at 48, you're gonna get slippage, because it's gonna open at 48 and you're gonna say, hang on, why am I getting filled at 48? Because that's the first available price. You've basically said, hey, stop me out if price trades at or below 49. It's not been at 49 yet. The first print is at 48. Your stop is going to get triggered. You're going to get filled at 48. You're going to be annoyed and you're going to have slippage. And then you're like, why can't I get filled at 49? Because it's never traded there. It just gapped straight through that. The first available price was trading at 48. And so you're unfortunately going to get slippage, which is why stops aren't perfect. But in most circumstances, especially if you're trading intraday, that's unlikely to happen and gap massively. You do get these type of things, but it tends to take over a period of time. That's not like in 1 second. Sometimes you do, very rare. But if you're trading a thick instrument, even if it's really bad news, it's going to take a few minutes to kind of wipe out a lot of the move, and you're probably going to get filled along the way down there unless you're trading big size. So that's less likely to worry about. This is a genuine thing that happens quite frequently in the market, depending on the markets you're trading. Obviously, if you're trading Forex, it's only going to happen at weekends. Trading some of the indices that trade 24 hours, it's only going to happen at the weekend. Trading stocks, much more susceptible to that, especially when there's lots of binary news on stocks as well. But one other thing I want to point out is, if you feel like your stop has not been filled, you're like, hang on a second, it wasn't a gap, it wasn't this, wasn't that, and I've not been filled, I'm pretty sure I'm not using a limit, I think it's a market. Don't be afraid to ring up your broker. You know, listen, these brokers value your business. Maybe that one person on the other end of the phone doesn't feel like it, but they do value your business. You know, they appreciate you being a client of theirs. And if you ring up and say, hey, listen, I had a stop loss on this, it doesn't seem to have been triggered, I don't really know why, can you look into it for me? They'll look into it, and if it's genuine, they'll explain why it's not been triggered, and you'll learn something, and maybe you're happy about it, you learn something. But it's not unheard of, rarer now, admittedly. I've not had it for ages and ages, but there might be a glitch in the system, and they say, hey, listen, you know what, that should have been executed. You did put that stop in at that price. I've had this many times in my trading career. Admittedly, when technology was just getting going and kind of online trading was kind of just ballooning and the tech was relatively new, this would happen quite a lot. Orders would not get filled. There'd be some sort of glitch. You'd have to ring up and say, hey, I'm pretty sure that should have been filled. And they go, yeah, and they fill it for you retrospectively. So not to say it can't happen, less likely these days, but ring them up. Don't be frightened to ring up and say, hey, stop's not triggered. I don't really understand why. They'll look into it, they'll explain it, they'll go, hey, you know what, we don't know why either, it's a glitch, let's fill it for you, sorry about that, apologize, put the fill on your blotter, and you'll be made good. So there's that as well. Unlikely, but there is that. It's worth mentioning. So why did my stop not get filled? You could have had a limit order, or if it's got filled at a worse price, one of these type of gap scenarios. So it's never perfect, but it's a good way of managing risk nevertheless. Take care, see you next one, bye bye.